We got a data-heavy week ahead of us, and so far it's not very good, as ISM Manufacturing once again showed us a bad combination of sticky prices paid in inflationary data alongside slowing activity. It's making me revisit something that I changed last week on my risk radar, which was the dollar light going green. I mentioned that I was thinking I might have jumped the gun, and it looks like I probably did. So I need to bring the light back down yellow as we're in a really interesting period of flux, because there's a couple good reasons why the dollar should be well supported. As I argued last week, central bank rate differential still favors the dollar strength as other central banks are about to cut and we're not going to. We still have generally solid data when it comes to employment and jobs, but the other big uncertainty is how we're going to trade around stagflationary data. Not necessarily stagflation, but slowing economic activity while inflation stays high. So a scenario where growth slows a little bit, but the Fed can't cut. My big question is, what do bonds and the dollar do in that scenario? And I think we're starting to get some answers. The other thing, too, is that I think that the central bank differential between what the ECB or the Bank of Canada is going to do versus us probably has started to get priced in now at this point, and now the market might be looking forward ahead about economic activity spurred as a result of cuts around the globe, whereas we can't cut. We're kind of stuck. And so the trade-off there is a little bit more neutral for the dollar than maybe I thought. The other thing, too, is just technically first on the chart for the greenback, we had a pretty clear rejection of what had looked like maybe an attempt to stay in this longer-term uptrend for the dollar. That was part of it, the reason why I had the green light. But, man, we broke pretty hard here today. So the dollar back below where we were just last month in May. I mean, that's a pretty big hit to the dollar. Now, I don't think it still has a ton of downside, the dollar necessarily, but when you see numbers come in light for activity like we got for the ISM Manufacturing, sub 50, a really bad drop in new orders while prices paid stayed high, that is stagflationary, and it's probably not good for the dollar. However, when stocks come under pressure, it limits the dollar downside too, because we still generally see that the dollar catches a bid. So if we get some stock sell-offs where the dollar doesn't catch a bid, then maybe I'll flip the dollar red. But for now, it's yellow. We also saw today again that when you look at what works in the market right now, the other currencies are a little bit firmer. Just look at the euro here, trying to push above our recent highs here over the last couple weeks. There's a good bit of trading in the euro, basically below 1.1 down to here. So it kind of seems like the euro, which is really the big mover of the dollar on the basket, looks like it might want to push up in that direction, because even though the economic data in Europe is not as good as ours generally, if they're going to cut and they're going to stimulate, then it gives a reason for the economy to maybe turn its rate of change higher, while we're dealing with a Fed that can't cut and our rate of change might be going a little bit lower. So I think all that calculus basically adds up to a neutral position for the dollar at the moment, unless we start to see the dollar really get hit while stock go down. Keep in mind, today stocks kind of grinded back to the close, so you never really got that bid into the dollar. You did get a bid into bonds, though, and that's the last thing real quick. A little bit of a teaser for this week I want you to think about, as I've talked about the 10s to the 2s and spread for the yield curve. When we see flattening like we got today, this was the move down in the yield curve when that number came out. That also gives us some information about how the market might trade around stagflationary data and why bad may not be good for stocks at this juncture. Bad data is okay for stocks if the Fed responds to it. Bad data when the Fed can't respond because inflation's too elevated, that's not likely to be good for stocks. So this is your setup for the week. I'm liking where the risk radar is right now. I think it's a lot of yellow, basically, and that makes sense because we're in a bit of an awkward period. Seems like last week we reached the limits of AI's knock-on effect outside of NVIDIA, and now we're reaching the limits of when bad data is good for stocks.